Hi, I'm Louis Llanes with Wealthnet Investments. Today I want to talk a little bit about how we're heading into the holiday season and how when that happens, a lot of times people miss out on profits. One of the things I've noticed over the years is that a lot of things happen after the holidays or during the holidays. And unfortunately, a lot of people wind up going on vacations. They're thinking about their family. They're thinking about other things, which they should be doing. But if you're doing it yourself and you don't have somebody who's actually watching it during that time, sometimes you can miss out on some profits. And I've noticed that what happens is when the markets get into a kind of a quiet period, people get kind of lulled into like nothing's going on. And when in reality, some great trends happen, both upside and downside. And in order to have good performance, the fourth quarter is really important. And so I'm going to talk a little bit about some of what I call, again, the robust portfolio construction concepts that can help an investor do well during the fourth quarter. And I'm going to kind of outline and go from some of the risk management features in particular, because risk management is the way that we truncate our losses. Therefore, it gives us the ability to take the right position sizes, the amount of money that we put capital at risk, and to generate profits in a good relationship compared to the risk. So that's really what we're looking for. We're looking for good profits compared to the risk. So I'm going to start from the very high level. When we look at risk management features for a portfolio, one of the things that we do is we do a portfolio level volatility assessment. So basically what we're doing is for our strategies, like for example, our dynamic growth strategy, we have a targeted volatility level between 12 and 15%. So we're basically looking to size our positions so that on a normal basis, we have an annualized volatility of 12 to 15%. We don't vol target necessarily. We're not super tight on that, but we want to, in general, we want to keep our volatility around that level. And the reason why we want to keep it around that level is because we know that many of the investors that are in that strategy really can withstand that. That's about the most that they want to risk that they want to see. And we just want to maximize our return given that risk level. And a lot of times what we see is that drawdowns in portfolios, which is how much a portfolio will go down from high to low, can be 1.5 to 2.5 times the annualized standard deviation. So in this strategy, we're trying to keep that somewhere around 20%. So 20% drawdowns. Now compare that to the market. A lot of people go, well, that sounds like a big drawdown in price. Well, you need to have some volatility in order to have good upside. And so we look at, if you look at the general stock market, it has had, based on the S&P 500, multiple 50% plus drawdowns. So this in general has a lower overall portfolio volatility target that we're trying to assume. Now that's on a long-term basis, and we have ways that we deal with that. So at the portfolio level, we're wanting to deal with the volatility, and we also have a concept called open risk. And open risk is basically when we take a position, we always predefine our risk. We say, okay, we really like this particular stock for all the reasons that we've outlined. For example, the fundamentals, the technicals, the trends, everything looks great. And we say, okay, well, we're going to risk X amount of price. If the stock moves against us by a certain amount, we're definitely going to cut our losses short so that we can recycle that capital into better opportunities, or maybe even re-enter it at a better time in the same stock. So when we do that, we have a distance that we're looking at, a total amount of risk of the portfolio that we're risking. And generally it's between 0.5 and 1.5%, 0.5 to 1.5% of the overall portfolio that we'll have at risk in a particular position. It can go as high as 2%, but we monitor that directly. But that's called open risk. That's the total amount of open risk for each stock. So let's say we have one stock that has 1% of the portfolio capital at risk that we're trying to make money on. Well, if we add up all the open risk for all the positions that we have, that is the total open risk of the portfolio. And we monitor that. So we try to keep that between 15 and 20%. Of the portfolio. And then we also have a market regime strategy at the overall portfolio level. Keep in mind, we're still talking about the portfolio level. So our market regime concept is basically we have a composite trend that we're looking at. We're looking at how is the market trending? And the reason why we do that is because if the market is not doing well, all stocks generally don't do well. It doesn't matter how great the company is. It doesn't matter how wonderful things are. Most stocks are not going to do as well. So when our composite trend indicators start telling us that the trend is weakening, we will not allow new positions to come into portfolio, and we will allow our risk measurements to fall in place. And so that allows us to reduce exposures if the markets continue not to do well. It's really, really important. So at the overall portfolio level, we have three basic types of risk management, or risk protocols is what we call them. We have the volatility element, we have the open risk element, and then we have a market regime element, the overall stock market. I'm talking about the dynamic growth strategy here, which is one of our most sophisticated strategies for people who want to manage the money in an active way in stocks. They don't just want to sit there in an index. They want to buy individual names that are doing well, that are trending well now, and size them accordingly, and to be active with them, and to turn the portfolio over when there's better opportunities that are coming into play, and to hold on to those winners. So somebody who wants, that's really the promise of this dynamic growth portfolio, is to hold on to those winners, find the very best quality trends that are happening in the market, and to own a diversified portfolio of those, and to manage the risks. Okay, so we talked about the portfolio level. Now let's talk about at the group level. So that's kind of the next step down. So we have the overall portfolio, now we have the group level. To us, group is a very specific thing. A group is something that is homogeneous, a group of instruments that are homogeneous in the way that they perform. So it can be sector-oriented, it can be industry-level oriented. So we dissect the markets based on their fundamental overlap as well as their industry drivers, and also as well as the correlation. We want to actually physically see, not only does the company fundamentally, logically, seem correlated to another company, but also does it also statistically show that. So if those conditions exist, then we kind of put them in groups. And the reason why we do that is because we want to be able to manage how much exposure that we put in a particular area. So, for example, right now, we've had a lot of stocks in the real estate sector do well, and some of our best performers right now are in the chip area. So there was a lot of chips that have been hitting our process that are saying, buy chips, buy chips. And basically we have to say, we're only going to buy the very best of those chips, the ones that have the very best trends, and we're not going to take all of them. We're going to limit how many we can get, because when those chips turn around and go negative, we don't want to have too much exposure there. So that's another risk management thing. So we want to go for the profits, but we also want to manage the downside. So we've talked a little bit about the group. We said portfolio, now the group, and then one more step down, we look at the individual stock level, the individual security level. There, we have two main risks that we're looking at. The first would be our initial risk. So if you can imagine a portfolio has a core capital, a base of capital that is involved. We use that capital and invest in it. And then once we've invested in that, they start moving up in price or down in price. That's kind of the open profit or loss, right? So we're looking at the core capital, how much of that core capital we're risking. So in each position, we have an initial risk that we basically will allocate. We call them risk budgets. So that initial risk will be maintained and monitored. And then the other thing is we have the ongoing. So let's say a position is doing really, really well. Like some of our chip stocks are doing really well. Some of our real estate stocks are doing really, really well. So when they start moving higher, then we're going to look at it now that we're in profit territory. We don't really have any open risk. We're looking at locking in profits. We don't want to let a profit turn into a loss. So what do we do at that point? Well, we say, well, how much of that ongoing volatility are we going to allow? So if you can imagine the high of the trade, we buy a stock and it starts moving higher, it's moving up and down and it gets to the high level. We're always monitoring from that highest part of the trade to our ongoing risk budget, what's that distance? And we monitor that as a percentage of the portfolio so that we can keep that part of the risk profile managed. There's really two very, very distinct pain points when it comes to investing. The first would have to do with choppiness. When you have choppy markets that do nothing for a year, 2 years, even more, it can be very, very tough for people and for investors, for all of us. So we want to deal with that part of it. And this helps us with that. We give our stocks lots of room. And then the other part of it has to do with give backs, where we have this nice run and then we give a lot of it back. And you don't want to have a round trip where you go up and down all the way to your initial point and turn into a loss. So we do a lot of quantitative analysis to figure out kind of the parameters that we want for that. We have different time frames we're looking at: shorter term time frames, intermediate term time frames, longer term time frames. So when we're dealing with our size, how much we have on a position, we're definitely looking at the ongoing risk that we have in that portfolio in an existing profitable position. Because an interesting, funny thing about investing is investors tend to remember the highest level that the portfolio achieved, as well as each individual stock achieved, as long as they've owned a stock. So you hear people say a lot of times, well, I own Berkshire Hathaway and I remember when it was at this level and now it's down here. Or I remember when Amazon was at this level, now it's down here, or Apple, whatever the stock is. So let's just kind of summarize that. So we're looking to be opportunistic. So that's the main thing, is we're looking to be opportunistic, find the best trends, look at the success factors that quantitatively and qualitatively make sense to own. We're really looking to be in those positions, but we have to manage the risk. And this is really, really important in the fourth quarter, where people tend to not think about their portfolio as much. So I would, if you're investing your own money and you want this type of strategy, you should consider talking to us. Go to our website, wealthnetinvest.com, hit request a meeting on the button, and you can learn more about it. But we have 3 levels of portfolio management we're looking at in terms of risk, or our risk features. We have the portfolio level, which includes volatility, total open risk, and market regime. And then we have the group level, which is the sector, industry. We want to make sure that we have those risk parameters under control, as well as individual stocks. How much initial risk are we going to put on in each investment, and how much ongoing risk we're going to leave for each investment. So that's really my message for you today. Many of you who are stock investors understand that investing isn't always easy. But in order to make good profits, there's always going to have those choppy periods. There's always going to be those choppy and give backs. But if you manage your risk well, over time, you have good risk-adjusted returns. Hopefully, that's where we're headed. And all of this is based on a reasonable basis of quantitative analysis over many years of data, thousands and thousands of sample size for these factors. And so many investors try to shoot from the hip. And many investors just try to be discretionary that way. That's not our style, because we generally trust numbers more than we trust the narrative. So we start with that. Now, we do look at the fundamentals in the narrative and as well, but we know that we want to have guardrails in terms of how much risk we're going to put on, in terms of how we're going to manage that portfolio. And we have to know when to admit you're wrong, because one of the best way to get asymmetric returns, which means your reward is bigger than your risk, the best way to do that, you can't control the reward, but you can control the risk more than you can the reward. So managing that is super, super important. I'm Louis Llanes with Wealthnet Investments. I hope you enjoyed this video. Be sure to follow me on Twitter. Follow us on Facebook. Go to our website, check us out. And if you have any questions, don't hesitate to contact us. Have a great day.